Hi everybody, welcome to this week's Middle Class Investor. This is Seth Martin, your host. It is Saturday, September 12th, and it's about 2:30 p.m. Today, I'm just going to talk a little bit about the markets. We had an up week, as you can see right here. This candle represents the entire week. Finished up almost 9 points on Friday in the S&P 500, and you can see we're just now kind of, it looks like, trying to work off a lot of this selling that took place. There's kind of there's a little bit of unknown around. There's always unknown around the markets, but there's a little bit more extra unknown because we made a low here, and usually when you make a low on a daily chart, you don't just take off back to the upside and start going. Usually the market it'll bounce, it'll roll over, and it'll test this low, and a lot of times make a slightly lower low. As you can see, we don't have that yet. But some people are saying that this qualifies for that. I'm not so sure. The reason it's important, though, is because it's the difference between the market bouncing to about where it is right now and then stopping and rolling over to bouncing up here closer to where this green line is, this green box. And so, it's the difference between Monday or Tuesday next week, the market's starting to sell off from here at 1960, or is it going to travel another, 80 points higher from here in the S&P, which is not insignificant. So therein lies the conundrum. But like I said, there's always a conundrum in the markets, and this one is no different. Let me show you one of the reasons why I don't think we're going to go to that box first. I think we're probably going to roll over and test this low. If we look at the E-minis, which is the futures for the S&P 500, you can see here. Let me zoom in a little. You can see these. You can see where the market made these lows. This low is way down here, and these lows are nowhere even close to retesting these. So this tells me that the E-minis probably want to go somewhere into this 1820 area, at least, maybe slightly lower than that, before we get a big bounce up into that 2040 area. I know that's a lot to travel. I mean, it's almost as far from here to there as it is from there up to the 2040. So we're kind of right in the middle of which way it could go. I'm currently positioned for it to go lower. If it goes much higher than this, I'll probably sell out of that position and try to re-enter. But, that's just the way the market is. Sometimes it could go one way or it could go the other, and you just have to place your bets and control your risks. So we are definitely, let's look at the big picture, okay? The big picture is we had a huge break in the market. If you look at the 5-year chart, we broke this churn line that goes all the way back to the 2009 lows. This is a big crack in the market. If you look at almost any commodity, let's look at a weekly chart. Almost any commodity you look at, oil, CL, crude light. This is, when commodities are selling off like this is telling you that the global economy is slowing down. That's what this is telling you. If you look at, well, we've been looking at gold, but let's look at gold. Gold has been selling off. How come I don't have my... There we go. You can see gold has been selling off since mid-2011. And so these silver looks the same. If you look at I don't know the symbols for all these, but if you look at, let's go back over to here and look at DBC, which is a commodity ETF. I mean, it topped back here in 2011 when gold did and has been selling off ever since. I mean, DBC, which is kind of a commodity basket, is down 52%. So, I mean, it's really just the market that was holding up. There was really nothing else in economic land that was holding up. So I suspect my gut feeling is, and you know, I've been talking about this market topping for a while now, but my feeling is that the indexes are finally catching up to what else is happening in the market. It's funny, I've been reading a book. It's called The Death of Money by a guy named Jim Rickards, who's very, 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 very smart. And, he was talking about, the reason I thought about this is because he was talking about 2011, September 11th, 2001. And, he was talking about how it wasn't so much a failure of intelligence. It wasn't so much a failure of policy. It was a failure of imagination that, as a community, we just couldn't imagine that, somebody would do what they did, fly airplanes into buildings. And I think kind of a similar situation in the market. I think people just feel like the market always goes up and never goes down. They know it fluctuates, they know it has pullbacks and so on and so forth, but they don't know, they really haven't experienced, if you look at a really big picture of the S&P 500, this goes all the way back to the 1930s. Right over here, this right here is the 1929 crash and sell off in the market. Doesn't look all that bad, really, until you measure it, and that's like 90 or 89% loss, okay? And then these little wiggles here, they don't look that bad, but if you go measure them, they're pretty significant, This right here was 50-something percent. And I suppose, see, the reason is I have it on a log scale. If I take it off the log scale, all of a sudden these moves look a lot more significant. 2000, it looks like it whacked the market pretty good. 2008 looks like it whacked the market pretty good. So because we look at these on a log scale, sometimes it doesn't really show how dramatic these sell-offs are. And that's just, I guess it's just a charting function, really, more than anything else. But I use log scale unless I'm trying to see, how significant a move is. And most of the time when you're trading week to week, month to month, it doesn't really matter what scale you're using unless you're looking at something that fluctuates a lot. But I think if you were in the markets in this month, which is March of 2000, there's just no way you could imagine that the market was going to sell off as much as it did over the next 2 years. From here to here. It went from 1,500 on the S&P all the way to 750. And I think that's kind of a failure of imagination, and we keep getting duped into, believing that the market only goes up. And of course, if you were, you look at someone like my father-in-law, for example, he was investing pretty much during this time right here. Even if you take that off log scale, that's always up for him. Up, 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 and away, right? So, but if you're like me and graduated college right here, Well, let's say that before I even had any money, it was probably 1996. So, yeah, the market went up pretty good. Let's take it off log scale again. Market went up pretty good, and then right about the time I had some money, it did that. So, it all depends on what you're used to and your perspective. The thing about it is we're at a place in history where the cycle, namely the interest rate cycle, is very, very, very large. And if we look at this and we look at this on a log scale, you can see that interest rates were really high here in 1981, 1982, and they've done nothing but go down. Now, if you go back, that's all the data. And you can see we're at historic lows. And the previous lows were back in the 60s at 3.8%. And then we ran all the way up here to almost 16% on the 10-year Treasury. And we've been following ever since. And, I think there's a lack, or there's a feeling that the Fed can hold these interest rates down here and, that they don't need to go back up. And it's another failure of imagination. These interest rates are going to go up. It's going to kill the market. It's going to kill all kinds of stuff. And it's going to be very taxing on our financial system and our economy. So I'm getting a little bit into the weeds there, but just know that these are very, very serious times. And yes, that's me talking. Here's the interest rate market. We normally look at a weekly, so let me pull up at a weekly. This is the 10-year Treasury. And you can see we had an up week, but we kind of rallied. I can't remember why I drew that line, but it's interesting that it ran right up and touched it and then sold off. But you could see interest rates pull back here and then start lifting again. And I think in pretty short order, they're going to take out these highs here and then move out to take these highs over here. And then slowly but surely, they'll be taking these little pivots out all along the way as they move up from these lows. Let's look at volatility. Volatility, again, came in last week. We see here that we had a pretty big spike in volatility. We've been talking about this all the way up into the 53 area. And then volatility has come on in. And we talked about volatility even coming back all the way back here to the 20 area. We drew this box here. Probably stay inside the box. It might get a tail outside the box and then have the body close inside the box. But volatility spiked. There's a lot of fear in the market. I don't think that's over. I think we're going to retest those lows in the S&P and the Dow. And, we can look at the other markets. Japan clearly is not going to make it to that. It might go back into this trading range and start trading in this trading range, or it could break down through here. We'll just have to see. Right now, technically, it's in the trading range. I would say odds favor in the very, short to intermediate term. It's probably going to be in this trading range, but it's probably likely to fall back through this trading range longer term. The UK came right down to that box that we had for support and is trying to bounce. Whether it'll bounce or not, I don't know. It may bounce a little bit, maybe up into this 18 area. Let's zoom in on this so we can see this. We might get a bounce up into this area right here, and then from there roll over and actually break this support area and come down a little lower. The market tends to move, from pivot to pivot. So you can kind of see here's a pivot, and then see there it made another pivot. See how it just takes out these highs. Sometimes it goes a little further. So these turns in the market are real important places. We want to identify. The ones right in the middle of the run are not so important. Like you can see, if you look at this run right here where I had the dotted line, you can see it pulled up, pulled back to here, and then pulled up again. you can see that on the way down, this line right here wasn't particularly important. But this one was, because this was the start of this major pivot. You can see a major pivot right here. It goes up like that. So this is the one we want to identify. Now, right now, there's nothing to identify. That's why one of the reasons I think what I think will happen in the market is this will go up into here and then roll over. Now we'll have a pivot that we can then create another area of zone of support off of, like this. Okay, so that's how that works, and that's why I'm always looking at those pivots. Let's look at we'll look at the euro in a minute. Let's go look at gold. We kind of already did. This is the big run up in gold all the way up to here. As we said earlier, gold's been pulling back since 2011, and it's trying really hard not to bust through this little zone that I've got. You can see I put the zone here, I don't know, a month or so ago. Actually, I put it here before these came in, these candles here. But you can look. It looks like we want to retest it. As long as we stay above this high, or above this low, pardon me, then I think gold looks like it wants to rally and probably head up into the high 1300 area before slowing down a little bit and rolling back over. And rolling back over, when I say rolling back over, sometimes I mean rolling back over and going lower. But really what I'm looking for gold to do is probably come to this area up here, pull back, into this area, and then make another slight higher high. But, who knows? There's no way to really know. You just have to kind of have to look at the market action and see what looks like a good reward to risk. Right now, to me, this looks like a pretty decent reward to risk. You got about a $200 move, looks like in gold, and maybe more. And I think the odds for that are pretty high at this point. So, and that's really the only thing you can do is you can just look in terms of what's probable. What's probable. It's kind of like looking at the market. I mean, is it probable, given that we spent 7 years at almost zero interest rates? Is it probable that we're at the let's go back here a little bit. Let's talk about big picture here. Here's the March low right here. So we spent almost 7 years going up. And that's not the right chart. There we go. So here's the March low right here. We spent 7 years going up. Is it probable that we're at the beginning of a new bull market? Or is it more probable that the market's trying to top here and is likely at least going to pull back? And you can see I've got this line on here. It's at least going to pull back to this line, to the 1600 area. Because that was that previous pivot. See, there's a pivot. And this is an important pivot right here, this one. So I'm saying the market's going to at least pull back into 1600. Now, if you own the S&P 500 at 2,100, do you want to just stay in the market all the way back to 1600? No. Why would you want to do that? So I don't think so. I don't personally. So this is why I study this so hard and remain so active. And just trying to keep the rest of you out of trouble to the extent you're willing to be active yourselves. So, all right, let's go to NinjaTrader. We're almost done for today. Let's look at crude oil. So you can see here in my MT Predictor software that I use, we got a little bounce in crude oil. Actually, this is a pretty large bounce. So crude oil, big picture, went all the way down like 60%, bounced here like 40% or 30%, rolled over and went down another 20% or something like that. I mean, it was crazy numbers. This move right here was a 10% move roughly. So crude oil is moving quite a bit here. Looks like it wants to pull back. My guess is we get a little bit more pullback next week, maybe the week after, and then we start taking off up into here. Ultimately, I'm looking for crude oil to test this pivot, which should be right around $65 and possibly a little higher. Sometimes they move beyond the pivot. Sometimes it'll chop around and then roll over right here and keep going. This is what we call a continuation. So this is kind of a completed looking move, and normally you get some sort of relief rally, usually up into this area. But sometimes it'll fall just short. And when I mean just short, I'm talking about like into this area at those previous closes, or maybe even the previous lows, like right in here. This low right here, this bar is the one I'm looking at. It's a key bar. And sometimes you'll get the market will just kind of chop and then start rolling over from here, and we call that a continuation trade, as opposed to this is usually you'll go to the DP, you'll pull back a little bit and then rally. Sometimes though you don't even make it to the DP and you just roll over and go lower again. I don't think that's what's happening in crude oil. I think it's probably on its way up into this area, but you have to be aware of that. If it starts looking kind of weak right in here around 60 and starts wanting to roll over, you got to get out of the way, because it's going lower, and probably much lower if it does that. Let's see what else we have. We've got the DAX. So we got this trend line here that we've had on since July of last year, and the DAX pulled right down to that trend line. Looks like it wants to bounce. We got a lot of selling pressure here still in the market, even though we got a good bounce going on. So I would look for the DAX to probably not make it too high, maybe just below this pivot. So let's zoom in on that, and I'll cover that a little bit more closely. So you've got a pivot right here. You can see the software's drawn it out. So, we're looking, this is an important area here. The DAX is either going to come up to it and go on through it, or it's going to come up to it and roll over. If it rolls over, it's probably going down into this area, below this pivot. Okay, so then all of a sudden, this area becomes important to the DAX. So identifying a rollover here is pretty important. So if you get let's say you get a bar next week. Whoops, that is not what I wanted to do. Let's say we get a bar next week and it closes below the low of this high bar here. So there's the low of this high bar, and we get a close below. Then look for the DAX to make its way down into a lower low here, lower than this pivot low here. Again, these pivots here are not near as important as this one here. So you can see the market stopped here, but likely only stopped to pause and to catch its breath, and is probably going down to here. It's my guess. And it's a guess. You have to guess in this business. Make your bets, so to speak. I thought I had a chart of the euro. Let's go back and look at the euro over here. Euro US dollar. The euro US dollar ran right up into our support box, our resistance box, and immediately recoiled from that, sold off. I suspect the euro is going to be making a lower low below this 105 area. Probably make its way down into this area below these lows back here. Now, if that happens, then the dollar, so let's look at the dollar, DX. You can see here we got some stuff drawn on the chart here for the dollar. So if the euro makes a lower low, what's likely to happen to the dollar? The dollar's likely to make a higher high. So this is what's confusing to me. The foreign exchange markets are confusing me around gold a little bit, because the reality is if this moves up from here, gold's got to go lower. Gold in terms of dollars has to go lower. So it's a little bit confusing. I'm not so sure. I'm kind of staying out of it. I thought the risk reward on gold looked pretty good, but the dollar still has me kind of questioning gold's price at this point. I think that's about it for the week. If we look at the ES big picture, let's look at a weekly chart of the ES. The reason I look at the ES so much, or the S&P 500, is it's pretty much the boss. It pretty much dictates, all the other markets eventually succumb to whatever the ES is doing, or the S&P 500 is doing. I tried to click to see if there were any waves here. So it looks like a third wave, but maybe that high is higher than that. I don't know because I haven't measured it. If you look at the YM though, I think the YM is a little bit more clear. Whoops, not clear there. Let's look at, that's only a 3-minute chart. Let's look at a weekly. So it's taking a few minutes here to load. A lot of data. Yeah, you can see here the YM got some DP signals up here. You got one that lost money on, but then this made this other one pretty quickly. And you can see if you'd have traded this, see what the target was. The target would have made 6 times your money. This was the target right here, 17,208. Of course, it blew right through that. So normally, this instrument is not being traded on a weekly basis. It's normally being traded intraday. So that's what these signals are set up for. If you were trading a weekly or a daily, you'd have probably some moving average here that you wanted to stay below, and then if it broke above the moving average, then you would exit your trade, something like that. Maybe I could show you a picture of something like that. If we look at, let me pull up something that would be helpful. Something like this right here is what I'm talking about. So here's the Euro US dollar. Let me kind of go through this real quick. You can see here that it broke down through these moving averages, sold off, and then rallied back up through them. But then you see the moving averages kind of just tightened up again, and the price action really never escaped very far from the moving averages this time, as compared to this time over here. And then it broke down through again. Sometimes you'll see this happen over and over again. And then it rallied ever so slightly there. Obviously in hindsight, this would have been a great place to go short. But what I said earlier about staying in as long as you're below the moving average, see how this moving average is rolling down and the price action is still below it. And then it started to come up above it here. And then, right in this area you would have exited. So you could have exited this trade, let's say at 1.1339, and you could have entered the trade around here, maybe after it broke this longer term moving average here, 200 period moving average at 1.3395 to 1.13. That's pretty good. That's like 2,000 pips. That's $20,000 on one lot. So it's a pretty good trade if you could make it. But this is what I mean by having some sort of moving average tell you when to get out of the trade, as opposed to just guessing. If I'm guessing, well, maybe this is a good time to get out of the trade right here. Who knows? There's no way to know. And so it's better just to kind of take the emotion out of it and just say, well, if it breaks above this moving average, then I'm going to get out. So right here, it broke the moving average. And if you said, well, not really there, it didn't, but here it clearly did. So maybe right here I'm out. So can everybody see that? I'm talking like that's easy to see, but it may not be. Depending on what your rules say, this may be where you got out, right in here. Or you may have had to have a close, in which case here's a close above the moving average right here. Maybe that's where you got out. So on this bar right here. So it just depends on what your rules are, but I was just really talking about using the moving average, staying in a trade as long as the moving average is above your price or below if you're long. In fact, a lot of people do that on long trades. If you look at something like Apple, people would get into Apple. Right here you had a pullback. So if you're not in Apple, you're looking at Apple and you're saying, okay, it's pulling back. And then you see it break above the moving averages and kind of flatten out. Well, right in here, this might be a good place to look to get in, right? Because it's starting to pull back, but it's above the moving averages, bounces. So you just get in somewhere in here, and then you ride it. Look, it stays above the moving averages pretty much until right there. This week right here broke the moving average. Somewhere in this 3-week period here in July, it broke the moving average. And then you say, I'm done, I'm out. I'm done with that trade. And you would have done really well. You would have gone in at around $75 and you would have got out at around $123, something like that. So that's how moving averages can be useful to take some of the emotion out of the decision making, so you're not kind of freaking out about watching your money go up and down. All right, everybody, that is it for this week. I really appreciate you coming in. I'm going to try to keep us out of trouble here in these markets, so keep coming back, keep listening. Tell your friends and family, have them come in and listen, and we will avoid this calamity that is the QE-driven, free money, crazy stock market action. So until next week, that is it for the I wanted to show you one other thing. Here's the YouTube channel. I'm sure some of you have seen this. If you're listening to this show, you've seen that page. This is what I was talking about earlier. This is a guy who has a blog site. His name is Deneric. It's Daneric. And I think it's Deneric Waves or something like that. He's a Elliott Wave guy. And you can see he's got a couple different options here. He's saying this one wave here down was complete. But then also he's given an alternate. The alternate is that it's not complete. You got a 2 would mean this is complete and we're likely going up here much higher. Now he says the alternate 2 is here, and that somehow from this area we would be going lower, which I think odds favor that. He's got it as an alternate, but I think the odds actually favor that we retest this low before we move up into this zone that he has up here where he's got labeled 2 and C. And you can see he's got it around 2040, what I was talking about, 2035, right this gap. We're going to probably fill this gap, might even fill this gap up here at 2080. So you have all this selling, and there's a gap up here. So we'll see. It's hard to say at this point, but we'll see. All right, everybody, thanks for coming in. I'm going to go ahead and cut it short, cut it right here. We'll see you next week on Middle Class Investor. Take care, everybody. Bye-bye.